When people first hear about Forex, it seems very complicated. You see currency pairs like Euro, USD, USD to Japanese yen, and it just looks like a bunch of random letters on a moving chart. You don't know what's happening. It can be a bit overwhelming at first. But once you understand what the market actually represents, it becomes one of the simplest and most logical markets. Forex is just the exchange of one currency for another. That's it. Very simple. Think about traveling. If you go from Singapore to Europe, you don't use Singapore dollars there. You exchange your money into euros. The exchange has a rate, and that rate changes constantly depending on demand. Forex is simply the same concept, but happening globally every second, with massive amounts of money. Let's break down something like the Euro USD. This is called a currency pair. It's comparing two currencies, the Euro and the US dollar. When you see EUR/USD at 1.10, what it means is that 1 euro is worth 1.10 US dollars. You're looking at the relationship between two currencies at the same time. This is where trading comes in. If you believe that the euro is going to become stronger compared to the US dollar, you buy Euro USD. If you believe the euro is going to weaken compared to the dollar, you sell Euro USD. So every trade you take is essentially a decision about which economy or currency is going to perform better relative to the other. Let's make it even clearer with a simple example. Imagine Euro USD is trading at 1.10. You believe Europe's economy is improving. Maybe interest rates are rising there, or growth is picking up, so you buy. If the price moves to 1.12, that means that the euro has strengthened against the dollar, and you profit from that move. On the other hand, if the US economy is stronger, maybe interest rates are higher or investors prefer holding dollars, then the USD strengthens and the Euro USD currency pair drops. If it moves from 1.10 to 1.08 and you had sold, that's where your profit comes from. Forex is not about guessing direction. It's about understanding relative strength. One currency getting stronger and another getting weaker at the same time. Now the real question is, why do currencies actually move? The biggest driver is interest rates. Every country has a central bank that controls its monetary policy. In the US, it's the Federal Reserve. In Europe, it's the European Central Bank. When a country raises interest rates, its currency often becomes more attractive to investors. Because higher interest rates means better returns for holding that currency. So global money flows into that country, increasing demand and pushing the currency higher. Another major factor is economic strength. If a country is growing, strong employment, strong production, strong consumer spending, its currency tends to strengthen because the investors trust that economy. On the flip side, if an economy is slowing down, entering recession or showing weakness, its currency often declines because money flows out to stronger economies. Inflation is another key driver. If prices in a country are rising too quickly, the purchasing power of that currency decreases. In simple terms, the same amount of money buys less over time. When that happens, the currency can weaken because it's losing value. Then you have geopolitical factors. Wars, conflicts, instability, or even political uncertainty can cause massive movements. For example, during times of global uncertainty, investors often move into what they consider a safe haven, currencies like the US dollar, for example. So even if nothing changes domestically, global fear alone can push currencies higher or lower. Now here's what makes Forex interesting. All of these factors are happening at the same time. Interest rates, economic data, inflation, global events, they are all constantly influencing each other. And the market is reacting to all of that in real time. So when you look at a Forex chart, you're not just looking at price movements. You're looking at the relationship between two entire economies being priced every second. This is why Forex can feel random at first. But it's not random, it's just very complex. And once you simplify it, everything comes back to one core idea. Which currency is stronger right now and which one is weaker? From a trading perspective, your goal is not to understand every single detail perfectly. It's to understand enough to form a logical view. For example, if US interest rates are rising while Europe is slowing down, you might expect the US dollar to strengthen relative to the euro. That gives you a directional bias. Then you use charts to time your entries. So if you take one thing away from this video, let it be this. Forex is not random numbers moving on a screen. It is a constant repricing of currencies based on economic strength, interest rates, inflation, and global conditions. Once you understand it, you can stop looking at charts like noise, and you start seeing them as reactions to real-world events. Now that you understand how currencies work and how they move, the next step is to zoom out a little, because not everything in the market is about individual currencies or single companies. In the next video, we're gonna talk about indices. You've probably heard about things like S&P 500 and NASDAQ, and how they represent entire groups of companies that move together. Once you understand that, you'll start to see how the bigger picture of the market fits together. See you in the next one.